Okay, so as I said, welcome everybody, and what this is our annual event. We start every new year towards the end of January. We go and do a general market outlook so that we can try to identify the macro picture of how things are going, which way, what are the trend changes that's coming into the market, what are the new events that is happening, what we cover most of the fundamental stuff that are happening around the world so that we can identify opportunity and and decide which where opportunity lies and how we are going to in this process of doing that. The way we trade here in Training Traders, we have a unique way, which is ours primarily, which what we call price behavior. And in that, the way we trade is we try to, we have, first of all, we trade, we have a principle that we trade what we see on the charts, and we don't voice our opinion, we don't do predictions, we don't say, okay, it's going to go up to 126 and it's going to stop and it's going to turn down. This is the rules that people that have the ability to foresee and predict the future, we give them that opportunity to do so, but we don't have that. All what we do, we try to identify the high probability trades, the possible direction of the market, and we try to identify entry points. I'm going to see all that on the chart. And we also try to identify our risk and take the trades. The key in what we do in the beginning of every trade, we think like fundamentalists. So we take into consideration all somebody says there is a sound in the background. I don't have any sound in the background. Hold on. I don't have any. I don't know. I'm not familiar with that. Maybe somebody else. Maybe Chris. Tell Chris. So we think like fundamentalists, so that we absorb all the fundamental events, what's happening in the United States, what's happening in Europe, what's happening in Japan, and the rest in China, and so on. And we take all this fundamental information, we come with a consensus of, if this fundamental information is valid, let's say, for a lack of a better term, then we have an expectation to look at the chart and see that the prices are behaving as per that expectation. So if I have, for example, that bad news coming out of Europe, then I will go to the chart and I have the bias of actually shorting the euro. But if I look at the chart and I see that technically I do have a buy signal and that the euro is going up, then I am going to trade technically, because the reason of doing this planning session, the reason for doing our weekly planning session, because we do the same session, not as in depth as we're going to do today's session, every Sunday, so that we can identify our entry point and our exit point. We do follow a clear and well-defined set of rules. They are very well defined, they are precise. We have precise entry rules, which we call the initiation rules. These are the rules that tells us this is the time we initiate the trade. And we also have a rule that tells us this is the time that we are to exit and to take profit, or this is the time now we get stopped out and we get and take our losses and leave the trade. Okay, so having said that, let me go to the charts and we can begin. The first thing we do in trading foreign exchange, and we do focus a lot on foreign exchange, but by no means it's the only thing we are going to be doing. We'll be covering a lot of things, and after I finish a topic, I'm going to open the forum for Q&A. So I'm going to ask anybody if he has any question. Feel free to type it in, and Malcolm and Chris is going to forward me your question, and I will be happy to answer your questions. So just to take the economic events that's happening around the world, and as I said, we're focusing primarily on the foreign exchange, and then we're going to delve into the stock indices, and we're going to look at some of the futures. To wrap up the events, the economic events that happened last year, there is a lot of economic news that is happening. There is a lot of fundamental developments that are taking place, and they afford us tremendous opportunities. So we start with the US dollar. In the United States, all of you know, we are having the debt ceiling issue. We have the issue of the fiscal cliff. The negotiations for the debt ceiling should be coming up within the next few weeks. And it seems that it will be resolved one way or the other, but what is happening in the United States is actually what the FOMC, or the Federal Reserve Bank, is doing. The Federal Reserve Bank is expanding its balance sheet. It is intervening in the US market by buying its own treasury. It is buying the treasury bill notes, like the 10-year note. It is also buying a lot of the mortgages that is owned by the banks, and in doing so, it infuses cash into the system. It's taking the notes or the loans that the banks are giving to people. They are buying it back. Therefore, they're giving money or cash to these banks, and therefore now the banks have more money to actually lend out to its clients. And with doing so, they are trying to stimulate demand. They are trying to raise demand in the United States. They're trying to have a little bit of an inflation. They're looking, and Bernanke is hoping for a 2% inflation. This has not yet been achieved, but anyway. And in doing so, he's using the monetary system, increasing the cash into the system in order to not let people actually get into savings, if you will. We want the American people, because 70% of the US economy is funded or financed primarily by its consumers, so it is the biggest consumer economy, and the American consumer is the force behind the economy. So if the American consumer now begins to see that money is now easy to borrow, he is now willing to borrow money and begin to invest either in the stock market or into other means, increase indebtedness, buy houses, buy housing, and all that kind of stuff, and that would energize the U.S. economy. Now, I'm not going to discuss the economic merits if this is good or bad. That is not my job to do that, but I'm just pointing to you that this is a major stimulus that's coming into the US dollar, and it has been having a great effect on the economy. If we're looking at the unemployment, you would see that it has reached now, it has come down from a 12% to close to 7.5%. We can see that the consumer confidence pretty much is back above the 207 levels. We can see that the sentiment is high, and also this infusion of cash into the US dollar has, as you can see looking at this chart, this is the chart of the US dollar. You can see that it is coming from the upper left hand side of the screen all the way to the lower right hand side. So you can see that the US dollar is pretty much still very weak and pretty much near the lows. The other currency that is now the currency du jour, which is one we have to focus on, which is the Japanese yen. And the Japanese yen is in a very unique situation. There is the new government, Mr. Abe's new government that came into power. The mandate of this government today and recently is to get Japan out of the deflation that the Japanese economy has been suffering from for the last close to 17 years, since 1997. And he wants to change the economy from being in a deflation state to turn that into to have an inflation. There is, as you know, that Japan has been charging zero interest rate pretty much for the last 5 or 10 years, and with that, even with zero interest rate, the Japanese investor or the Japanese was saving his money. He's not taking his money to invest. And if I want to describe deflation to you, is that the cost of goods and service is declining every day. There is no demand coming into the market. So if you wish to buy a car and it's today worth $10,000, if you wait for a month or 2 or 3 months, you will be able to get this car at a cheaper rate, let's say for $9,500. And if you wait further, you will get it cheaper. So the longer you wait, and that what depresses the economy and puts it into a deflation. So what he's trying to do, he's trying to create inflation. And inflation is the opposite of that, which means that the prices of goods and services rise in value in the future. So if the cost of a car is $10,000, if you wait for 6 months or a year, then the price of this car is going to rise up to $11,000. So it is better for you, it is much more cheaper for you, or it's going to be money saving for you to actually go in and buy it now. And with that, the way to do that, by using any of his available monetary things, the only thing that he has in his hand at this moment is nothing more than turning the printing presses on and to print the yen. And whatever the amount of yen currency that is available today in circulation, it is expected that within the next year or so that this amount of yen would be increased tremendously. Now, looking at this chart in front of you, this is the chart of the Japanese yen, and this is pretty much the area when Abe came in and he has announced that this is now the new mandate of the government and that they will hold no resource in achieving the 2% inflation. Now, whether he will succeed or not, this is left for the economist and for history. This is judging that is not our role here, but it is our job to identify the opportunity. What does that statement that he made over here means? It means that they are going to be printing the Japanese yen. They are going to buy the US dollars. They are going to buy the euros. They are going to buy all the other currencies, and in exchange they will be selling the Japanese yen, and therefore they will be damping the value of the yen. And looking at this chart here, based upon what we call the rules of price behavior, this here is what we call the structural point, and that is the break, or what we identify as the first leg in the bear market in the Japanese yen. Now, today as we speak, today is the second day of the meeting of the Bank of Japan, and in the meeting of the Bank of Japan is attended today in the committee. It's attended by the economic minister and the finance minister, in addition to the members of the BOJ. And if you read all the news that's coming out, the stress or the statement is that two things that we have to be aware of. One is that the president of the Bank of Japan, his name is Shirakawa, he is going to be leaving the Bank of Japan by the end of April, and there is a new BOJ president that's going to come in, and he of course is going to be handpicked by the Prime Minister of Japan. He will be somebody that follows his mandate, he agrees with his point of view, and they will be bringing in or stimulating the Japanese yen. The other thing that printing the Japanese yen would do is it is going to create what is known as a negative real interest rate. So any Japanese investor that is buying bonds or saving the Japanese yen will be costing him more money to actually hold this yen, and therefore they will be going out of the yen and trying to put their money either in currency safe havens, and these currency safe havens are the currencies that are for countries that have goods and services that as part of their GDP. So you're looking at Australia, you're looking at Canada, you're looking at also the United States. So the money would primarily be going out, and the New Zealand dollar. The money would be going out of the Japanese yen and going into the US dollar, the Canadian dollar, the Aussie dollar, and the New Zealand. So that is the premise, and right here when we're looking at a trade with the Japanese yen, you will be doing it knowing that the wind is in our backs. We have the support of the BOJ. They are going to be committed to come in and buy. The other currency that is happening or finding a similar situation to today is the Swiss franc. And by looking at this chart, this is the weekly chart. And as you see over here, when the prices did go and trade above the 108, this is the Swiss, these are the indices. These are the charts that I'm showing you. These are the charts of the indices. This is not just the dollar Swiss or the CAD. This is the basket of the currency itself. And with looking at these baskets, we are going to do the first step in doing our trade selection based upon price behavior, is identifying the strong currencies and identifying the weak currencies, and then we do a pairing. So with this, when the prices did trade above the 108.59, that would have appeared that that is the beginning of a possible trend change, because the market has been in a bear market. That is the first structural point to the upside. Right here, that would have been the first break up, and that would be leg number one in a new bull market. But what happened is this thing did not follow through to the upside, and it began to turn, and this is the second break. That means that this is what we call in our trade a failure trade. This is a failure trade. This, in a macro picture, you have a bull market that is started to move over here, has actually started to fail right there, and now the bias is to actually take that Swiss franc, and now we should be looking at shorting the Swiss in our, and the Swiss, the story behind the Swiss is, as you well know, that the Swiss National Bank during last year has announced that it is pegging the Swiss to the euro at a rate of 120. And during the whole of last year, let me show you, the whole of last year, and this is an amazing chart, it is fascinating. During the whole of last year, as you can see here, this is the 120 level. Everybody that was trying to sell the Swiss franc, trying to sell the euro and buy the Swiss franc from the beginning of 2012 until September 2012, this trade had two parties. On one side was the Swiss National Bank, and on the other side was the public going short. These are the only two players that were in the Swiss. All the big hedge funds, all the big money, if you will, were coming in. They did not believe that the Swiss National Bank would be buying or supporting the Swiss to this extent. They believe that there will be a limit. There would eventually, the Swiss National Bank will throw in the towel, similar to what happened with the Soros trade in England, back in the UK, back in the 90s. So they were expecting that the Swiss National Bank will have a limited budget or a limited pocket to finance the purchases of the euro, and that eventually the Swiss National Bank would give up, and they were looking for this to decline. But it seems that the printing presses is also working in Switzerland. They are just buying at no end, and finally, right there at the beginning of January the 11th, this is the reversal that appeared in the Swiss, and now there is the realization that these public are now beginning to cover their shorts, because they practically have given up on their being able to break the Swiss franc down. And therefore, we can see now on one side the Bank of Japan lowering the Japanese yen. We can see also here simply, I mean, this is such a unique chart that it hasn't been seen. I haven't seen anything like it for a very long time. I mean, this is such a trade that you can tell, but just by looking at the chart, who is on either side of this trade. Therefore, again, you want to be shorting the Swiss because you have a very big player on your side who is going to be selling the Swiss. We have the BOJ selling the Japanese yen, and we have also the Swiss National Bank selling the Swiss. Okay, going to the rest of the currencies. If we go to the Australian, and we're going to do this quickly, this is the chart for the Australian dollar. Looking at this, you can see that this is a very powerful, fundamentally strong currency. It is pretty much, I mean, if I put the weekly chart on this, you can see we're pretty much near the all-time high. Everybody should be, or theoretically should be, looking at the Australian currency as a strong, one of the strongest fundamental currencies in the world. And what we need to have a confirmation that this is factually correct, that this analysis, just by looking at this chart, that this is a bull market in the Australian dollar, we need some evidence. Not that this is not a bull market enough, but we have an event that we look at this chart that is a little bit concerning. If you see here, the all-time high, if you will, based on the index, again, this is the index, it's not the Aussie dollar itself, it's just the basket of the Australian, so it's different than the unique individual pairs. This was the 104.49, and when it broke above it here in March 2012, putting a price point of 104.93, that should have led to a major break to the upside. We should have had an explosive move to the upside simply because of the power of this trend. I mean, this trend began from the 2009. This is a 3-year trend to the upside. Now, when you break above the 52-week high, after having a 20-week or so congestion, that should have led to a continuation or a new leg to the upside. And in this case, that was the first failure to do so. This was the second attempt to break above that, which has also failed. This is the third attempt, which also has failed. This is the fourth and fifth attempt, these two, because as you see, they are all above the dashed line. They have failed. And then here, this is the sixth attempt, which has reached the point of 105.47, and that is the highest level. This is an actual bona fide break above those structural points, and there was no follow through to the upside. And this is where the concern comes in. Why? Because we have Japan now lowering its currency, devaluating its currency. We have the United States, by printing dollars, it is evaluating its currency. We have also the Swiss franc, the Swiss doing that. Now, that is going to have a negative effect in some way on the Australian economy by raising the cost of all the exports. Anybody that wants to buy anything from Australia has to pay for it by Australian dollar, and that would add to the cost of them just simply having the Australian dollar at that high level. The Royal Bank of Australia has announced that they are now considering lowering the interest rate in Australia, and they are looking to ease a little bit of the monetary policy. They are paying now 3-point-something% interest on the Australian dollar, and by looking at this here, we can see that pretty much whatever the Australian government is going to do now is going to be an effort to lower the Australian dollar. So our bias is because of the so-called the beginning of the events that's happening in the world. Now we're having the initial steps of a currency war, because in a currency war which was happening between Japan, Switzerland, and now the United States, is that each country is trying to take away the exports of another country by lowering its cost of its products. So now the Australia has to protect itself, and the only way it can do that is that it will also try either to lower their interest rate, and we can look for the Australian dollar in general to decline, or if not, to stay in this sideways pattern, to stay into this congestion, if you will, to continue in this formation. So we are going to be neutral to the Australian dollar with a slightly positive. We will only buy and commit ourselves to the long side of the Australian dollar when it breaks above these highs, if and when. If it doesn't, we are going to be neutral to negative for the Australian dollar. Okay? So we did the yen, the Swiss, and the Aussie. Now we're going to look at the Canadian dollar. The Canadian dollar is, again, one of the commodity currencies. It is one of the best economies out there. It does pay a small interest rate on its currency, and it is pretty much closely correlated to the US dollar. And as you can see, it's pretty much the same as the Aussie. It is kind of this neutral pattern. This is a weekly chart, so this is from latter part of 2010 till now. We're still trading below the 101.58. So again, we will be neutral for the Canadian if and when it comes above this, what we call the structure point of the 101.58. That will be our buying point. Until that point, until it goes above that, we are going to remain neutral, because they will not, even though the Minister of Finance in Canada a couple of weeks ago has mentioned that they will be looking at the possibility of tightening their monetary policy, but I don't see any tightening that is going to come in the near future, especially with the events that is happening, as I said, in Japan, Switzerland, and in the United States. That is actually a precursor or a prelude to a currency war. I mean, this is even Russia. The Minister of Finance, the Russian Minister of Finance, came out on television 2 weeks ago, and he has made a shot across the bow, if you will, to the Japanese government that lowering the Japanese yen this fast, this quick, is going to be detrimental to him, and they will not allow that, and blah blah blah. So what can, as we can expect, that now the effect of what Japan and Switzerland are doing, and the United States, is beginning to be felt around the world. So I don't see the Canadian actually either raising interest rate or doing anything other than. So we come to the euro. The euro now, we have been strengthening. It has been tied very closely to the Swiss, as we said, at 120. But right now, it has begun. If you look at the big macro picture for the chart of the Swiss franc, for the euro dollar, if you don't know that this is the euro dollar and you are analyzing that chart, you can say that this is the upward trend all the way to the momentum high that was placed back in 2008. And since 2008, it could have had, if some of you, for the newcomers that are attending with us for the first time, which we don't use, if you wanted to use a Fibonacci, I'm just showing you this for the sake of discussion. You would see that this is pretty much, I'm just showing you this. You can see that this here, that whole pullback that we've seen in the euro is less than a so-called 50% retracement. We don't use the Fibonacci, we don't use indicators, but I'm just trying to make the case to the people that are joining us for the first time. So this is just a 50% retracement, and according to the technical rules, as long as we have not, even if it retraces as back as 61.8%, that means that the bull market is still intact. And with that, you can see that the euro has become traded above the 131.95 right here. That was the first structural break. Then we came back and sold off. So here that would have been our first failure. So we should have said, okay, we're going to go short. This is a failure, like I showed you in the Swiss franc. But here, what happened here is different than what happened in the Swiss. Here we had the break, so right there we have the failure, but that failure was followed by a reversal, and that is a magnificent reversal. That is a weekly chart. It has taken back, that 1 week reversal has taken the high of the previous week, the high of the 2 weeks before, and then the high of the 3 weeks. That reversal has taken up a 3-week highs. It has engulfed, if you will, the prior 3 weeks, and right now for the last 2 weeks we're still sitting above the 33.21. That should mean that the euro so far should continue to go higher. Having said that, we also heard from Mr. Juncker, who is I think the president of the ECB, that he was quite concerned about the speedy rise in the euro, and he said that he is very concerned about this rise, and that would be detrimental to the eurozone. This statement was made on this day. And as a result, that we had this major liquidation over here, but the market turned around and now it's above. So even with the concern that has been announced by Mr. Juncker, what we have now is that the market is saying, and that's why we say we trade what we see, not what we think. We have the statement that they are very concerned about this rise, but what's happening here that the market is actually buying this bad news. If somebody is concerned about the rise, this means he wants to bring it down. The market is moving into the opposite direction. So this is good action on good news, bad news, and I'm having good action in the market. So the market is supporting or not reacting negatively. We should have had something similar to this if we are to be bearish on the euro. So the euro, we should be neutral to positive on it, or actually positive. Okay? And last but not least is our British pound. And this is sadly the weakest currency so far. So in the group of the currencies that we looked at, this is the weakest currency so far. We have now, on a weekly chart, we have been in this very wide range from 2010, and the 160.64, this is our structure, and we have come here, and now we have reached the low of 158. This is a very negative bias on the pound, and we should be looking at being negative on the pound. So the pound, we're looking for further decline to the downside. Now, once we do that, and this is what we do at the beginning of every session, we go back and plan our trades. And the way we plan our trades is this. In foreign exchange, as you all know, you're dealing with two currencies. The way we approach the foreign exchange market is we primarily buy strength and we sell weakness. And by doing what we have done in the last half an hour, we begin to judge our currencies. So we have said that the euro is reasonably strong. We are kind of positive to neutral to the US dollar. We are positive and neutral to the Australian dollar. We are, let's say, again, positive or neutral to the CAD. Okay, and we are negative to the British pound. Also the Swiss, we should be negative on the Swiss. Okay, so when I put 1 minus, this is a grading system. So 2 pluses is stronger than 1 plus. This is a grading system. And 3 minuses over here in the Japanese yen, for example, this means that this is the weakest of all. So if it's very strong, it will have 3 pluses. If it's medium strong, it will have 2 pluses. If it's okay, then it will be 1 plus, and so on. So right now, if I'm going to plan my currency trades coming in, I will be looking at taking the strong currency and I will pair it with the weak currency. Why? Because foreign exchange is unique. You are buying one currency with the proceeds of the other. So you want to buy the strong one so that keeps on moving higher, so you make money on its rise in valuation, and you want to sell the weak currency because the further down it declines, you are making more money. This way you're maximizing your return by. So our first choice will be buying the euro dollar and selling the Japanese yen. We are going to be buying the dollar and selling the yen. We are going to buy the Aussie and sell the yen. We're going to buy the CAD and sell the yen. Then we can also buy the British pound and sell the yen. But bear in mind that the pound is also weak and the Swiss is also weak. So we can expect, and the Japanese yen is weaker. So in this case, it will still be a gainful trade, but it is not going to be as good as the euro yen or the dollar yen or the Aussie yen or the CAD yen. Okay, so primarily we're looking at these pair vis-a-vis the yen, and then if I wanted to look at other currencies, I can be looking at taking the euro, which is a buy, and I can pair it with the pound. So I can go along the euro pound, I can go long the Euro Swiss. I can also go long the Euro CAD, and I can go also long the Euro Aussie. So in my focus point on the currency this week, we'll be looking at shorting the yen across the board and looking at buying the Euro Pound, Euro Swiss, Euro CAD, and the Euro Aussie. We can also be taking short the Pound Dollar. We can also be taking short the Aussie Dollar. We can also be going long the Dollar CAD. And we can also be going long the Dollar Swiss. So these are the matchups that we're going to be using. These are the ones that we're going to trade. And I am, before I wrap this, I just want to show you, this is how we enter. Let me stop this right now, the recording. These are the pairings that I said, so I'm stopping the recording. If anybody has any questions, feel free to ask it now. And